Good afternoon. My name is Doug Bartoli. I'm President and CEO of InPlay Oil Corp. We're a junior oil and gas company based out of Calgary, Alberta, Canada. We're predominantly a light oil focused producer that's in the Western Canadian Sedimentary Basin. If you like value, getting paid a 6 to 7% dividend, and growth with low debt and lots of upside, this is a good story for you. When you take a look at our corporate strategy, we have a good track record of delivering per share growth through multiple cycles since we went public in 2016. But our corporate strategy is to continue to provide top tier production per share growth, strong free adjusted funds flow, keep leverage ratios conservative, and that will allow us to increase returns to our shareholders. 22 was a great year for us. We provided top tier production per share growth. We had significant debt reduction and delivered our initial return of capital to the shareholders. So our record production that year was 9,105 BOEs a day, 50% oil and NGLs. That was 51% growth on a debt adjusted per share basis in over 21. We had record adjusted funds flow of 131 million. That's 178% growth over 2021. And free funds flow of 53 million, predominantly used to pay down debt, 59%. We ended the year at 0.2 times net debt to EBITDA. And at the end of November last year was our first monthly dividend of 1.5 cents per share per month, or equivalent to 18 cents per year. And we also did a normal course issuer bid, or quite frankly, easier said, a share buyback program. Now, guidance this year is 91 to 9,500 BOEs a day, but most importantly is growth in light oil, which is the highest revenue driver of all of our commodities. So somewhere north of 7% in 22, which maximizes our revenue and our funds flow. Now, funds flow of 103 to 108 million this year, free funds flow of 23 to 33 million. Now, first half of the year was lower commodity prices and certain production issues along the way. But right now, where we sit today, where production is, and where we get much higher commodity prices in the second half of the year, which I think I quite frankly predicted last time I did an interview here with Jasper, of 59 to 65 million, which is 118 to 130 million annualized. So really great second half of the year, staying in that 0.2 to 0.3 times that debt to EBITDA range. You know, we're going to drill 16 to 17 net wells this year. We got strong reserves, reserve life index. We got 89 million shares outstanding, fully diluted 93.7, a market capitalization of 2.75 at $2.75 Canadian per share of 246 million, with debt 288 million enterprise value. Now that monthly dividend at 275 equates to 18 cents a year, of course, and 6.5% where we currently sit. We're trading about 380,000 shares per day over the last 6 months. And, over the last month, about 355,000 shares per day. We got employees and directors own about 6.4% of the company, with a large inside shareholder of over 22%. Bank debt at the end of June or the end of second quarter was 45 million, with about 42 million drawn on our current credit facilities of $110 million. We got a very strong management team, very technically oriented, history of value creation. We've had a recent change where one of our initial, fourth person in the door back in 2013, Gordon Reese, our Vice President of Business and Corporate Development, has retired. He's been in the business for 35 plus years, actually pushing 40 years. And we just brought on Kevin Leonard in the role of Vice President of Business and Corporate Development. So 18 years in investment banking and in the capital market side of the business. He's going to be a great addition to our team. All of our bios are in the back, and even more detailed bios are in the on our website. So, and again, our board of directors, a very experienced industry board of directors within the oil industry in Canada. Just Craig Golanowski is the chairman of the board, and he is at Carbon Infrastructure Partners. They're the 22.5% owners that we talked about on the prior page. So again, ingrained within the company and significant shareholdings with their board position. This is always my favorite slide. I mean, you have a strong history of top tier production, per share growth, and debt reduction. Now, if you take a look at the top left corner of our production chart, the light green, that's our oil and our natural gas liquids. That's where the revenue gets derived from. The orange is our natural gas. The blue squares is production per share growth. And again, I reiterate this every time. If you grow production and you grow reserves on a per share basis, ultimately you're going to create value for your shareholders. As long as you don't do it all with debt and you don't blow things up. Now, great growth since we went public in 2016. That was only less than a quarter in that year. In all the categories, you can see the production per share growth really moved up through there. We survived 2020, the COVID year, of course, and continued to start showing some great growth through 21, 22, and a little bit flatter here through 23. But most importantly, we're trying to grow that light oil production somewhere between 7 and 11% in 23 over 22. If you go over to the reserve side, in all three categories, proved, developed, producing in green, total proved in purple, total proved plus probable in orange, ready orange. We were growing organically from 16 when we went public, our reserves nicely every year. 20, we were able to do a fabulous deal in a very tough environment, which made us one of the top reserve growth companies amongst our peers in 2020. We did another great little deal, purchasing a company called Storm Energy in 21. Again, increasing our reserves, our sustainability of our company, and all very accretive, as you've seen in the blue square, the accretion and the growth on a per share basis. So strong history of growing production and reserves and doing acquisitions that significantly help us grow production and reserves. How does that relate in the bottom left corner when we take a look at funds flow? So, funds flow is what we use to pay for everything within our business. Again, good growth every year. We peaked in 19 when we were 5,000 BOEs a day at about 32.2 million. You can see our funds flow per share was growing in the blue squares every year. Under 10 million in 20, just survived. That was the key. We survived, and I would say we thrived with the deals we were able to do in 20 and then through 21. Again, so we moved up to just under 50 million of funds flow in 2021 and close to 70 cents per share. And of course, 22 record commodity year, significant growth in production from 5,700 to over 9,000 barrels. We got 130 million of funds flow and around $1.50 per share. So this year, lower commodity prices, we're projecting mid-range about $1.20 per share in funds flow. Leverage, back in 17, 18, 19, we were dropping our leverage every year nicely. This was pretty standard for the industry to be running 1 to 2 times debt to EBITDA leverage ratios as an industry. And, places like the U.S. used to even run higher, probably 2 to 3 times, and in some cases higher leverage ratios. 20, it bumped up significantly with the low funds flow in the survival year. But after COVID, huge accelerated reduction in our leverage to where we are today in that 0.2, 0.3 times debt to EBITDA. So very, very comfortable place to be. By far and away, the strongest operating and financial position I've ever been involved with in any company in my 30 years in this business. So, it's getting a year old, but we had a decent year, a strong year in 2020 in our reserves at the end of the year. I think the key to it is on our year-end reserve report, proved, developed, producing reserves, our net asset value is about $3. On a total proved basis is $7. We're trading, 270, 275 here today. $3, we're trading below what we consider our proved, developed, producing net asset value. So great value. Historically, most of the industry would trade closer to a proved basis. There were times when you traded on proved plus probable, but this is something that I believe we will start working ourselves towards as we get more stability in pricing and what the commodity prices are going to do, and as we move what I believe into a multi-year oil bull cycle. We find our reserves at a very, very efficient basis with what we've been doing with our program of organic and acquisitions. We're always in the top of what I would call our oil-weighted peer groups. And that's what we show on the next page. Top left corner is our 2022 proved developed producing finding development and acquisition costs and recycle ratios. But I'll focus on the finding and development acquisition costs, which is the blue bar. So we were number 3 amongst a peer group here of oily weighted companies. And if you look at our proved developed producing finding development acquisition costs on a 3-year average amongst this peer group, we were number 1. So again, we've been 3 years averaging very, very strong costs to find proved developed producing reserves in the ground. On a total proved basis in 2022, again, we were number 3. So both PDP and on a total proved basis, we were number 3. Our 3-year average total proved finding development acquisition costs, again, put us at number 1. So again, strong history of finding reserves and adding production at a very, very strong capital efficiency, around 16,000 a flowing barrel. When we take a look at our long-term forecast, we look at providing, with our current assets, the way they sit, closer to 10% production growth at $80 WTI. And if it's closer to 60%, we would project maybe 6% production growth. The key to that, though, is on the oil side, focusing on that because that is the revenue driver of and the funds flow driver of our business. Now, you can kind of get a feel how we see our production growth over the next few years and production per share growth. Everything else is in the table here of that growth. And we're using a relatively conservative price deck of, I believe we're at $78, $75, $74, and $70 in 24 and 25. So currently for the rest of this year, we're easily over our $80 forecast. As today, we're sitting around $87. And you can see the building up of working capital, to a positive working capital by the end of next year of $11 million on that strip pricing or that forward look commodity price, and $50 million into 2025. So very, very strong free funds flow, sustainable business. Again, that free funds flow is available for dividends, for share buybacks, tactical capital investments, and strategic acquisitions. I mean, even, if WTI went to $55 from now to the end of 2025, we would still be able to maintain our dividend. And that's what we're showing on this top right chart here. We're showing our capital program in purple. We're showing our free funds flow in green through that range. And we're showing our dividends currently at 18 cents per year, or about $16 million a year in the orange here. So again, right down through $55, we should be able to, we will be able to maintain that, our current dividend as it sits today. Do I believe oil is going to be $55 for the next 3 years? Pretty hard to imagine that right now. 75 plus is probably at the lower end of where you're going to see things level out there. So really, really strong position. So again, as I mentioned earlier, our head office is based in Calgary, Alberta. 85% of our production is coming from a zone called the Cardium. The Cardium is Pembina and Willesden Green in the Alberta map in the top right corner. That's a 2.5-hour drive to the middle of that field from Calgary. This is old oil field. This Cardium Pembina area up in the north here, this is the oldest, largest conventional light oil pool in Canada, in Western Canada. We're using new technology. We're extracting more oil out of the ground. It's been around since found in the 50s, been around, developed in the 60s, 70s, water flood put in place through that time frame into the early 80s. And guess what? We're still drilling in this area. It's been around for what now? 70 plus years. It's going to be around for probably double that time frame. How are we showing this oil growth, or this top tier light oil growth, and how good is our sustainability? Well, big chunk of that is all going towards the declines. This is our declines of our proved developed producing reserves right from our reserve report. So that's a third party, fully independent reserve evaluator report. And at the beginning of the year, when our reserve report was brand new. It shows about a 26% decline in 23, working to an 18% decline in 24. Now, of course, we're drilling, so we're adding a little bit to that decline, but again, very, very manageable declines. So Willesden Green, we've drilled more wells in Willesden Green this year than we will in Pembina. We did an acquisition here in 2021, I think November 30th it closed. It added to our land position in the south, and we've been drilling here since. We've got a lot of locations in this area, 180 locations. That acquisition pretty much doubled our land holdings here, increased our inventory just about by double. Strong continuous land base. Was accretive on many metrics. And on one of the metrics that we're most concerned about, it was significantly accretive. And that's the free adjusted funds flow per share metric. That will allow us to increase returns to shareholders over time, which is pretty much the most important factor right now to shareholders, as that's what they're demanding. Pembina. So we just currently run a 3-well program up in this northwest corner here. As we speak, we're drilling the 3rd well of a 3-well pad. Again, we got a lot of locations here, 153 locations. This acquisition we did in 2020, WTI was still below $50. I think it was actually closer to $46 at the time frame. We were able to get that acquisition done with our banks, which was very difficult at the time considering where WTI was and the leverage ratios that we were running at. So no dilution to our shareholders. I think $1.9 million to purchase that acquisition, just under 300 BOEs a day. We've hit it over 3,000 a couple times. We haven't drilled here too much lately, a little bit less than that. But to put it in perspective, we paid the cost of the acquisition, the first 6 wells and all the facilities that were required for those wells. We paid them all out in about 10 months, 9-10 months. So spectacular numbers. In fact, $1.9 million to buy this. In 20, we had funds flow of $22 million, or net operating income of $22 million in 2020. 21, and in 22 we had funds flow of $77 million off of this play. So just under $100 million of net operating income in just under 2 years. So strong track record in both cases of doing an acquisition and really getting strong payouts on them after the acquisition. So our well economics, let's focus on Willesden Green right now. Capex of, and we'll just focus on the 1.5 mile well, but capex of 3.4 million Canadian recovers us around 300,000 barrels of oil equivalent. IP 90, so that's our initial production over the first 90 days. That's about 325 BOEs a day. IP 365 is about 200 BOEs a day. So the first year, that's our average. Strong finding costs, strong capital efficiencies. At $80, we're paying out in under 3/4 of a year here. Strong internal rates of return. So that's just drill, complete, equip, and tie in. That does include potential facilities and other costs around that, but really, really strong economics. The good thing about the Cardium, it's such a well-established play. There's so many wells penetrating the zone or going deeper through the zone. It's geologically mapped out and very, very understandable. But it provides what I would consider some of the best low-risk returns in the Western Canadian Sedimentary Basin. When you take a look at our 2023 forecast, so the lower commodity prices in the first half of the year averaged in the low 73, just over $73 WTI. We have now got actuals into the end of July, and we're using $80 from August till the end of the year. And of course, like I mentioned, we're just under 87 WTI US today. So that's gets us an average of about 77.15 US oil price for the year. And Edmonton par. That's what we get in a Canadian basis after the exchange rate, after some transportation, and after some quality differential. So just under $100 Canadian. Those are fabulous numbers. Gas price, we dropped a little bit from our previous forecast in the beginning of the year to $2.80 per gigajoule. Ultimately, we'll have about 103 to 108 million yearly adjusted funds flow. But with the higher production and the higher commodity prices in the second half of the year, if you annualize what we estimate over our production range, it's about 118 to 130 million. Strong adjusted funds flow. So that's what's got me excited for the rest of this year and going into 2024. Of course, we have 23 to 33 million of funds flow, with a significant amount of that, or free funds flow, with a significant amount of that coming in the second half of the year. And then our dividend payout is around 16 million for the year, giving us a free funds flow yield of, somewhere in the middle of this range, in the low teens. Ultimately, again, 0.2 to 0.3 times net debt to EBITDA by year end. Here's a key though: for the rest of the year, if we're up $5 WTI, you're going to add another 5 million of funds flow to that equation. So just a sensitivity there, which currently we are in that range for the rest of the year. So we just put out our 2022 sustainability report. It's available on our website. So continued reduction in greenhouse gas emissions. That's the biggest thing we can do as a conventional light oil producer. We also put out, just how we sit against our peers in the bottom chart. We sit against a group of light oil peers that report greenhouse gas emissions. We're number two. We've been consistently number two in 2020 in the green, 2021 in the red, and again 2022 with the blue column there. So not everybody has reported yet, but again, very, very strong position amongst our peers. That's it. We've executed our strategy significantly here. 22 was a great year for us, put us in this great operating position that pretty much gets us through thick or thin these days. 23 is going to be a good year. The second half is going to be a really good portion of the year, generating some significant free funds flow. Our long-term forecast shows the sustainability of our current dividend down to what we believe even $55 WTI for the next 2.5 years. Quite unimaginable from what I can tell. We are positioned well with our pristine balance sheet to execute on additional accretive acquisitions. I've got a track record of doing great acquisitions. And then, we will continue with our strategy in 2023 and beyond, which is top-tier production per share growth. Strong free funds flow generation, keeping the leverage ratios conservative, and ultimately increasing the returns to our shareholders.
Before we go into the most recent quarter, could you just give the viewers, tell them about yourself and about your track record?
Yeah, I'm an engineer. I'm approximately 30 years, been working in the industry. I've done everything in the industry from field operations, all operations, production, facilities, completions. I've done now a significant amount of A&D exploitation type work, and now, of course, corporate work. The only thing I've never really been through my career here is a true drilling engineer. I worked with them, but I just never spent time in significant time in drilling operations on a full-time basis. So just a wide range of throughout the industry and the different pieces of that puzzle. And this is my second iteration of a public company. The first one did a great job growing it from 600 barrels to 10, 11,000 barrels, and then selling it in 2012 at a very good time. After going through some tough times, specifically the financial crisis in 2008, 2009, and lots of commodity volatility. But, as I said in the presentation, this company where we sit today, large or small, and at any time in my career, I've never been involved with a company that's in such a good financial and operating position.
Great. And now I would like to talk a little bit about the past quarter, Q2, usually the toughest quarter of the year. Could you summarize the most recent quarter?
Yeah, the second quarter is typically spring break up here in Canada, where the frost comes out of the ground and snow melts, etc. I'm sure you know a little bit about that, but it's not typically happens in the United States. This was probably the most difficult quarter I've ever been involved with in my 30 years as far as issues. there was lots of, the easy part of it, there was lots of turnarounds, mostly on third-party natural gas facilities, which we use to take away our gas in most instances. We have a little bit of our own operated facilities, but a lot of it is third-party facilities. The biggest one is the largest midstream company's facility in the area. It's called Kiara Rimby, and it's a deep cut facility. It's our preferred place to send the majority of our gas. We get a lot more liquids out of our gas. They haven't done a turnaround since before COVID, so they had about a 18-day turnaround planned in June. Of course, it's an older facility. You take it apart, you find problems. It lasted about 25 days. So the things that happen there is, that's our preferred place. We have, because we send a lot of our production there, we have a preferred contracts with them. We were able to move most of our gas to other facilities. It's kind of like the electrical system. You got pipes are connected. You can move things around. But again, we don't have preferred contracts with these other places. Plus, everybody else moved to these other places. So there was a lot of pressure in that system, which backs all the way back down to the wellbore, puts pressure on the wellbore, and it affects your production. And secondly, typically it costs more too, because again, we don't have preferred relationships with it. And the last piece of that puzzle is we get a little bit less barrels of oil per day of gas versus what we would get if we take more natural gas liquids out of the stream. So I think this year was an interesting year. I think a lot of people after COVID delayed turnarounds. There was less production going through there, less revenue being generated. This year, with projections that natural gas will be quite low during the summer. Specifically, they probably would have been much below $2 if it wasn't for the wildfires. I think people predicted a lot of turnarounds. So you're seeing these turnarounds, you're seeing pipeline maintenance occurring quite a bit this year, and all these pieces are just kind of putting just issues around being able to get rid of that gas. And of course, we cannot flare gas here in Canada. It's very difficult to flare a lot of gas, unlike many places in the world, including the U.S. and places like Saudi Arabia, where they flare sour gas quite frequently. So, we have pretty much the strictest. I think us in Norway always sit at the top of the charts as some of the strictest environmental regulations in the world. And then other than that, the other piece of that puzzle was the wildfires. I mean, I've seen turnarounds that last longer, everything else. But the wildfires was something that was quite new, and I've never experienced to this level before, where you're shutting in 40% of your production for a period of time there. Anyway, that comes with problems too, right? You shut stuff in, not everything comes on perfectly. Some stuff doesn't come on. You got to spend more money to get it on. So there's little nuances to that. You take a look at the fires this year. I mean, I think at time in Canada, you probably pushed 400,000 plus BOEs a day, maybe 500,000 BOEs a day. It was down at one point. And a significant portion of that was gas, and in northern Alberta, some of that gas was down for a long time. That's where I say if it wasn't for probably 3-4 BCF being down for certain periods of time, I think you would have seen our natural gas prices, AECO here in Canada, be a lot closer to $1.50 for a majority of the summer. That removed a lot of gas that would have went into storage in June there. So
the deep cut facility had its turnaround in June, and the spring breakup is over. But do you expect any issues with the production curtailments to persist in the second half of 2023?
Yeah, I mean there are more disruptions in the second half of the year. I mean that facility has had other downtimes post turnaround. There's some pipeline maintenance projects going on that again is causing issues moving production around, pressure to the system. We have our turnaround. It's not really a turnaround, but our startup of our new plant. So we'll be down for a few days when that occurs. So there's lots of little pieces. I think again, this is an anomalous year on that, where we haven't seen this amount of turnarounds for quite a while. So a bit of an anomaly, but in general, like we we believe we got that forecasted in our current guidance that we have publicly on production.
I mean, with these turnarounds, do you have to pay anything, or do you only pay for your existing gas plants?
Yeah, well, I mean, you pay the fees, the processing fees, and things like that you're going to the new facilities. And as I said, you're typically not going to your preferred facilities, and so you don't have a better deal. I mean, you're kind of subject to a little bit to what they're going to offer you for price, and because we can't flare. Which is a good thing. We're subject to that cost. And, again, with gas being like 15% at best of our revenue, we want to make sure we get rid of the gas so that we get our oil, keep our oil producing, get that to market and getting paid on our oil. So you don't see that on oil. Oil's different. We have facilities that are tied directly into pipe, but also we can truck to terminals that are tied to pipe all over the place. And we do truck all over the place at times. We truck oil just to different terminals because we can get better. You could spend an extra $1 a barrel trucking to another facility, and you could get $2 a barrel better pricing at it. So like oil's quite a bit different in moving it around. So it's typically natural gas facilities that cause more of the issues.
So in other words, if we talk sale points, the price you get for your light and medium oil is tied to the mixed sweet blend. But could you get different pricing depending on what sales point you sell to? I mean, I assume Edmonton Par isn't just one sort of one singular market.
Well, yeah. I mean, it's a little bit more complicated than just you get Edmonton Par. You get an Edmonton Par, and there's a quality adjustment, but you can go somewhere where they have less. Maybe they're short oil for the quarter, and you're going to get a better price going there than you are going somewhere else. So I mean, it's a reference price, right? That's what they call MSW reference price. It's not the exact price. There are other little pieces to that puzzle, but generally it's close, right?
Yeah, it is, especially with your oil that has a low sort of $1.50 Canadian dollar quality differential. That's more or less the same. Speaking of gas plants, you're working on a second upgrade on a natural gas facility in Willesden Green. Could you explain how is that going to impact InPlay, and how much is it going to cost?
Yeah, so I mean, we did one gas plant in the Willesden Green area through the Prairie Storm acquisition. We have two gas plants that came through them, but generally older gas plants that haven't been much done to them for quite a while. The first one we went through Q1 and came on in April. That was the smaller of the two. The bigger ones is now here in September. So this is an upgrade, but it's also, we're changing out some other equipment there, specifically compressors, very old compressors. And if one of these compressors has a significant failure, we might not be able to find parts of it. So we're changing out compressors there as well, which is important. It allows us to continue to flow well and find parts for stuff if things if there's any issues with those old compressors. But we're also upgrading the whole the refridge facility, which is the piece of the puzzle that takes our liquids out and gets our gas quality to a pipeline spec. You can't put too much liquids in gas pipelines, right? So you got to get a certain amount of your liquids out. Deep cut facilities gets more liquids, which generally have higher prices. Then the natural gas liquids have higher prices than natural gas majority of the time. Maybe not at $10 or $8 or something, but those are once in a while phenomena. But bottom line is that's what we how we look at that side of it. As far as what it does, like we're adding with the new refridge system at our facility, it's expanded as well, which in turn allows us to continue to drill and show growth in that area.
Could you sort of explain the downstream structure?
Yeah, I mean, any natural gas facility, whether it's us or a third party, is basically built on a sales line or close to a sales line. And yeah, once you take liquids out of the gas, once you get the gas to sales pipeline specifications, it's going into the sales pipeline, which again is typically AECO pricing, give or take. Like I say, like back to, as far as Canada goes, whatever we use in Canada, that's great. It stays here. We only have one other sales point for gas, which is why I say it's not a global commodity to us. We go to the U.S., so we don't have a lot of options on the natural gas front as far as pricing.
But are you operating the natural gas facility, and do you also have sort of some third party that are processing its gas through your facility?
Yeah, I mean that's what we were talking about. Like, yeah, so I mean the two. I mean, we wouldn't have spent capital on facilities that we don't operate, right? So that those two in Willesden Green we operate. We have some small facilities up in Pembina for the appropriately sized for what we're doing up there, but in Pembina, other than that, we have third-party facilities on the growth areas. And then in Willesden Green, some of Pembina, East Pembina goes to Rimby as well, which is pretty much the largest midstream deep cut facility, kind of on the west side of the province, central west of Alberta. And then in Willesden Green, again, we have our own facilities that go directly into the pipelines. So typically we have lower cost structures like operating costs and stuff in our own facilities, but of course less liquids, natural gas liquids extraction out of them. So it's a bit of a toss up there. But the same thing is like to build deep cut facilities is multi millions of dollars. We're spending $7-8 million this year upgrading facilities, which is a big year for facility spend for us, which I don't expect to see every year. But I mean, these guys were building massive facilities in the Montney for hundreds of millions of dollars. Like that's why midstreamers do it. That's their game, and most E&P companies don't want to be putting their capital into that type of facility.
In other words, you're not looking to expand some of your facilities and get more third-party revenue by processing their gas.
You have to find a deep pocket partner because like I say, it's an expensive venture. Well, yeah, I mean, it's difficult to do and to worry about third-party processing. Like you got to get agreements well in advance. Otherwise, you're only building for yourself because you're not going to build something that's oversized, beyond your own means without commitments from other people. And then again, these things nowadays, like it's gotten worse, right? Like you don't just, I'm not building a new facility in 6 months. Like you're talking, I don't think you can build a facility in a year and a half hardly these days, right? Just the whole process from start to finish, that's probably a good scenario. So lots can change in a year and a half, 2 years.
In terms of alternative third-party natural gas plants, how many are there? Have you been looking to get a first contract for another one?
It's pretty difficult to go anywhere else. I mean, like I say, we do tend to be able to move stuff. But, I guess my belief is, the other piece of the puzzle is we're sitting at all-time highs of natural gas production in Western Canada, right? We were over 18 BCF a day. We're just under 18 BCF a day. The drilling slowed down since winter and through Q2 with the fires, started to pick up a little bit again. But you're at all-time highs. So I mean, my view and my belief is that, again, the midstreamers are there to make money, and if they can do expansions, they'll do expansions because they see more gas production. Because if they can, they'll do their math, and if they can make their rate of return, they'll add capacity to their facilities that are already in place. So you probably will see that as we move forward. You'll also see LNG, right? So what does that take away from the whole system? Like it is intertwined, like it's interconnected in many ways.
we're already almost, I mean, 2/3 of Q3 is done. So how do you expect Q3 to differ from Q2 in terms of production, free funds flow, and other corporate events?
Yeah, I'm excited about the rest of this year and going into 2024. And I mean, it's all in our guidance, and we talked about it. I mean, production is going to be higher, and for the year, I think we're 103 to 108 million of funds flow. But for the second half of the year, if you annualize it through our guidance, you're sitting there more like 118 to 130, and that's at $80 WTI from August to the end of the year. Well, guess what? We're 80. Last I looked was 86, 88 or something here today. So that $5 million is, or that $5 extra WTI is $5 million extra funds flow for me, right? So, again, we're in a great spot. I think when I was on talking with you in June, I predicted that like oil would move its way into the 80s throughout the summer and get stronger throughout the summer going into the fall, and that's exactly where we're at. So, it's a great spot, and we sit at multi-year low valuations as an industry. I mean, we're deep value, balance sheet, low decline, balance sheet, low leverage, and we're paying this nice little dividend while we wait for things to turn around.
So in the past quarter, you had a particularly low royalty rate. It was very low due to the Crown gas cost allowance. Could you explain what is that allowance, and is it an annual recurring credit?
Yeah, I mean, so the gas cost allowance, it occurs every second quarter, and it's like you look back at the prior year, it gets done, and the Crown takes their revenue from us on their sales of oil and gas products, or we pay it to them through sales, especially on gas. I think on oil they can take it in kind. Bottom line is it's an estimate. It's not our best case estimate. But then when you do the look back, did they pay too much or did they pay too little? Very, very seldom does the Crown pay too much. Generally, they pay too much for their processing and everything. They pay less, and then we have to adjust, and they agree, and they make an overpayment on it. So that's what it is. And again, when you move gas around a lot to different facilities, you get different cost structures. And during the year, it's a much more of a set fee based on the last year, and then you do this adjustment. So this year was a big year. Last year, I think there was some, but it was a much smaller. And we weren't the only ones. There was quite a few companies that announced a significant gas cost allowance in the second quarter of 2023 here.
So the next time we see the cost allowance should be in this quarter or the past quarter in 2024.
Yeah, it's always in Q2 of every year. So yeah, so next 24 will be the next time. I mean, I think we did get some money back in 22 or 21, which we showed in 22, but it was small, right? Like it. So every year, so there's a lot less disclosure on it, right?
Great. And while we're speaking of cost, as you move up to 10,000 barrels of oil equivalent per day, which you will be doing this year, where do you expect sort of the operating expenses to come down to on a barrel equivalent basis? Yeah,
I mean, we've been in an inflationary time period here, so I mean, I would think that we should get back into closer to $14. Hopefully below that, but has inflation been subsiding? I think it's not coming down. I think it's found its point right now. But there's so many different pieces to that puzzle. As far as even fuel costs, they creeped up quite a bit. They didn't come down when pricing was coming down, when fuel costs were coming down, but now fuel costs will be going up again with higher oil prices. This is an operating cost, but on the capital side, we've seen, steel started coming down. So our casing tubular products, but now there's some issues with getting steel tubular products from outside of North America, which in turn, we're starting to see steel creep up again, which was not expected. So you're getting little bits and pieces. The good thing is the utilization of the rigs is actually lower in North America than it was here through winter and last year. Both Canada and the U.S. is a bit lower right now, so those costs have sort of, not. There's been no more increase in those costs. So
all of your wells are extended horizontal wells. You're mostly drilling 1.5 mile wells to get better. I assume that you get better well productivity on them than on the 1 mile. But are all of your wells frack wells, and how's the permeability of your sandstone?
yeah, I mean, so generally we're drilling we're drilling I don't know, 13 to 1600 meters vertically from surface. Then we're drilling 1600 to 3200 meters horizontally. With, you're right, our preferred distance is about 2400 meters or 1.5 miles. We're doing multi-fracks through the horizontal leg. We're putting a fracture completion in. We're doing it every 30 to 45 meters. So on average, on a 1600 or 1 mile meter well, we're doing about 50 fracks. On a 2 mile or 3200 meter well, we're doing 100 fracks. And on a 1.5 mile, 2400 meter well, we're doing about 75 fracks. So it's kind of neat. Like, it's like putting, in a throughout the section of land, or throughout the land or the horizontal well bore, you're like putting 50 to 100 little vertical wells within that well bore through one surface location, right? So you're limiting the surface impact by doing this. But it's also, this is what basically has, opened up the shale boom that's occurred in North America and other places in the world now, I guess. And it's enabling us to get, oil and gas from much tighter sands. So, and then permeability, you asked, so again, we drill through the best part of the reservoir and we drill into the bottom of the reservoir in the Cardium. The bottom of the reservoir is, they call it bioturbated, so it's sandstone intermingled with some shale. So it's got lower permeability than the high quality stuff at surface. But then we frack through the bioturbated, the low permeability stuff, into the high quality stuff. The high quality stuff was where the vertical wells that were started drilling in the Cardium in the 50s and 60s, is what the vertical well produced out of. The vertical wells did not produce out of the bioturbated. We're now liberating oil out of the bioturbated, but we're also taking oil out of the quality sand above that, where you've had oil not recovered through the vertical wells. So because we're putting fracks so close together, you're getting oil out of that higher quality sand. So, I mean, as far as permeability goes, the bioturbated can be 0.1 to 0.5 millidarcies, and the quality sand could be 1 to 10 millidarcies. So you got a good mixture there that, of the whole reservoir that you're accessing.
What recovery factor can you usually get out of it ultimately?
Yeah, I mean, so it's been a significant improvement in the recovery factors. Like, I believe at one time, the Cardium was estimated to have, 9-10 billion barrels of oil in place, and now it's double that. And I think the recovery factor was probably in the low to mid teens, and now I think it's probably going to get into the low to mid 20% range. So again, when you're talking 19-20 billion barrels of oil in place, that's a lot of oil sitting there. That's why I say this field's been around since the 50s and 60s, and it'll be around another 60 or 70 years.
Does it differ between Pembina and Willesden Green? What sort of in the first year? What decline usually is?
I mean, you know what? They're generally all there's not a whole lot of difference in rates and declines and in initial production rates. Like certain areas within Willesden Green are great, are better, and certain areas in Pembina are great and better. And so certain areas have more gas, and certain areas have more oil. And that's all dependent on the structure and the geology of the area and of the Western Canadian Sedimentary Basin in general. But again, we also have to look at takeaway capacity and everything else is all considered in when we're drilling and in the timing we're drilling. Access to the land is another piece that's, you've got. There's some crown land, so owned by the Alberta government. There's some non-crown land, which could be owned, it's going to be owned by ranchers, farmers, etc., that you got to deal with. So, but I mean, as far as rates and declines, the type curves are, and I think we have it on the one page in our slide. The type curves are generally similar in their declines, and I guess I always would. You talk about the declines, like I would say 50% of our wells are, and those type curves we're making so that they're a bit conservative so that we beat them. But I mean, 50% of our wells are right on that type curve, like within a few percentage points. 25% are below, and 25% are above. That's how we kind of view it. Like and different little things could happen within the operations of it, and drilling and completions, and it's always hard to put your finger on it, but it's a pretty consistent type curve that we're seeing in our areas, and again, that's why I say your risk of it. It's not like you're stepping out too far and drilling new wells, like potentially you are in some of the Clearwater and some of the other plays as you delineate the pool and move out. I mean, this pool's been delineated for many years, not only with Cardium vertical wells, but with wells that have gone much deeper for production out of the Manville zones and deeper zones.
Could you walk us through the drilling program for the rest of the year? You're finishing the 3-well pad at Pembina.
Yeah. So good question. I mean, we were just finishing when we released the second quarter, 3 wells in Willesden Green, and they came on second half of August. Then we started drilling 3 wells in Pembina. We're currently finishing the 3rd well on that pad. We'll start completing here. This would be early next week. So those will be on in the second half, probably the last week of September. And then we'll start drilling. The rig will be moving off for a bit, but we'll start drilling in early October. And currently we have 3 more wells around 2.5 net working interest in October for the rest of the year, and that's predominantly it for the drilling program. Good thing with Q2. Q2 is our free funds flow kind of offset what we did in overspend of cash flow for capital program in Q1. Q3, I think we'll have a little bit of free funds flow, but Q4 will be a significant free funds flow quarter for us with the smaller capital spend.
Say that the WTI stays at $80 a barrel. How much annual organic production growth are you looking to target per annum in percent?
Yeah, I mean, look, like, we put out there at our current, the way we look today, at $80, somewhere around 10%. If you go to $60, we'd be looking more closer to 6%. With that, I mean, our target, more importantly, is oil when the gas prices are lower. That's where the revenue's generated. So we can, if the oil is the biggest part of that growth, that's, showing that 10% growth, that's the best place we can be. Now, I don't see us growing any more than that. Honestly, like, we've got all the research and everything else, and nobody's paying you for massive growth. Nobody, like we've got all of our peers and large, big, small companies, like, you're not getting paid right now to show growth, and you're getting, it's all about return to shareholders, it seems to be, and running a business that you got return of capital, which this industry never did forever, right? We just grew for growth's sake when times were good and production was needed and prices were high. There was no return on capital. There was very little return to shareholders. Well, the shareholders are now Wall Street, Bay Street, institutions. They're all wanting returns. And you know what? It's actually such a better way for us to run our business. And I've mentioned this a few times in different, and I might have said this in the fall, that this is a great way to run a business. And if I spend every ounce of my extra cash flow on drilling to grow, I'm increasing my declines, and then the cost, commodity prices come down, and all of a sudden I've got higher declines. I need more money just to stay flat, never to grow, which in turn puts us in a spot that you might not grow. Do you want to waste that money and or would you rather have a really good balance sheet and be able to maintain your dividend? And ultimately, we're seeing that dividend is completely alleviated the volatility in our stock price and many other people's stock price, because now you can be patient. You're getting paid a nice little cash influx while you wait for the cycle to change, or the view to change, really, right? Because I'm a multi-year oil cycle bull guy, and I believe the multiples will expand. Our cash flow multiples will expand. History has done that over and over and over again. But you need to see, and a belief that we're going to see years of a much higher oil price, not one that goes from 95 to 65 or lower. And we got to get through this current environment with the recessionary fears that's occurring right now. That people think, well, you have this massive demand destruction, but generally, I think we've seen over the years that, unless it's a massive recession, depression, potentially, you don't have enough demand destruction for a long period of time that can cause you so much grief. It's usually high prices, aggressive drilling for growth into these high prices, which in turn you have a bit of a slowdown, and you got too much supply, and you get these big swings. Well, guess what? I don't see that happening anymore, the way the industry is operating, and it's great. And our goal is to be one of the most capital efficient, and to take the free funds flow, increase those free funds flow on a per share basis, and give that back to our shareholders.
We're drilling 17, 18 wells this year. If you would like to grow 8, 9, 10%, how many wells, and now I'm talking 1.5 miles, do you have to add per year?
I think you're going up by 10% a year. As you get bigger, you got to add a little more wells. You potentially you start drilling too much, you add a little more decline. But you're somewhere in the 10-15% add of wells a year to show that growth. And it depends where you are. It depends on the mix. If it's a little gassier or oilier, like if we drill in gassier areas, we can grow more than that probably on a BOE basis. But again, our goal is to manage, funds flow, free funds flow, capital efficiencies, things like that. So, if we can grow our oil side the most, that's the focus.
So in other words, you don't think that you would have to add more than sort of 10 million Canadian per year in order to have that kind of growth, 8 to 10%?
Yeah, that's a good number. You're talking 3 wells at 3.5 million, so somewhere in that range, yeah.
Let's move into the capital structure. You renewed your senior credit facility in Q2, and what interest rate do you have on the drawn and also the undrawn portion?
Yeah, so the interest, interest rates are going up and down with SOFR, or pretty much prime, give or take, however you want to. It's very similar type numbers. So we go up and down with the interest rates accordingly, and then it's actually based on a matrix of our current leverage ratios. So the higher leverage, you're going to add more percentage points above and beyond your prime rate. Right now we're probably, which again is the good thing, is it's a very small number of debt, like I say, the lowest I've ever been involved with. But we're typically paying probably 8 to 9% on what's drawn on our facility. And then the standby fees are about 0.75%.
So in other words, the margin from prime is 2%, somewhere in that range?
Yeah, probably 2 to 4, again, depending on your leverage ratio.
With almost 40% of the oil equivalent production coming from natural gas, if natural gas prices would rise, or at least, consistently over a year average above $3 Canadian, that would be meaningful, especially if it would come close to 4. That would be really meaningful for you. But so with LNG Canada and with LNG Gulf Coast coming online in the near future, what's your view on natural gas in, say, coming 3 years?
Well, we got into that conversation. My view in general is natural gas is going to be less volatile. I don't see swings of 10 to $1.50 as much anymore. I see something more consistently in the, a wider range, 250 to 450, maybe more narrowed down, $3 to $4, or somewhere maybe a little bit higher. But I just think you're going to have a more consistent natural gas price as we move forward. And then the reason I don't say it's going to be so much more consistently, could have some swings up, but I just think the swings will be mitigated a little bit. You could have some swings up, but again, there's a lot of natural gas in North America. And for that matter, there is a lot of natural gas in the world. And again, I think my view is in general, though, we're doing it, we're not doing a good job with it, is because it should be the fossil fuel of choice for energy transition, right? Like that everybody wants to see. We're moving to electric cars or whatever, and that's great. But where's the electricity coming from? Right? And I mean, natural gas should be the prime fuel to generate new energy. You're getting stuff out of China saying that, well, they're going to be 40% EVs by a certain time frame. Yeah, they're going to be 40% EVs that are going to be powered by coal. That's great. Good job.
You're permitted to repurchase 6.5 million common shares, which is 10% of your free float.
Yeah, no, 89s are, of our free float. Yeah, sure. So, yeah, you're right. That's what it is. There's different pieces of the puzzle that the TSX asks or allows you to do. Yeah, I mean, as far as purchasing shares, we use it as a kind of a last, if we really think that there's severe undervaluation, it's kind of a stopgap measure to buy some shares back. So we use that part sparingly a little bit. Our key is to make sure that our dividend is the piece that stays sustainable, and in periods of severe drops, we'll get a little more aggressive on it.
Okay, so in other words, I mean, you have it in place, but it's not your way of returning capital to shareholders, at least primarily.
Not at this time. I mean, part of the issue is we'd like to conserve. We have a pristine balance sheet. We like to conserve that balance sheet to use that balance sheet for some acquisitions, which in turn allows us to get bigger, to get larger, to get more free funds flow per share. And the larger your market cap and the bigger you get, the more eyes are on you, the more institutions that are on you, which we believe is fairly important.
Yes, and in order to grow to $1 billion company, M&A is required. And could you give us an update on the state of the M&A market? Who are currently the sellers, private cos, larger packages?
So the M&A market is interesting. So who's selling? In most cases, it's private companies. There's a lot of private companies that have been around for quite a while, and they've survived through 2020. They've went through the ups and downs prior to 2020. We've 21, 22 been pretty good years. And if you're private equity backed, every year that you don't sell, your percentage of return is dropping. So a lot of this is private equity backed, private companies that are selling. The other piece of that is you're getting larger companies that generally have too much leverage, and they're trying to sell non-strategic properties to pay down their debt quicker and allow them to continue to focus on what would be considered their top properties that they want to put their capital to work towards.
Would you like to add some color? What type of M&A targets are you looking for or looking at?
So we're typically looking at oily assets. But in reality, we're looking at assets that are going to add to our sustainability. I think, I've said more than once, we want to do accretive deals. We want to see us be able to execute quickly on the deals and get a quick rate of return, which again, I think we've done a fabulous job with. But when you look at it and the way the industry is and what shareholders are looking for, one of the key pieces of that puzzle is free adjusted funds flow. So, I mean, if you can do deals that are going to be accretive on a free adjusted funds flow basis, that's one of the biggest pieces of the puzzle. We look at inventory, we consider the liability of the plays, everything else, but that's how we view it all. Accretive on free funds flow is highly important. We look at, in the end, is it oil or gas, or is it heavy oil? A bit agnostic, we're typically focused for light oil assets. But I mean, I started the first 5 years of my career in heavy oil, and then the next 5 years of my career in heavy medium crudes. So it doesn't work. If the right asset is there, and that type of product will be there as well. So
I like that you're agnostic to the type of oil gas, although it probably will be oil weighted, because I mean, buying a gas dominated asset then has to be at a steep discount. Yeah, there are advantages with the heavy oil plays, quite low operating expenses, relatively low declines, and with the Trans Mountain pipeline, the WCS spread is decreasing. So, have you become more interested in heavy oil the past year?
Again, sure, a little bit. We've looked at those type of plays. We're not scared of them. I mean, the funny part is typically the plays that are selling right now are kind of in the hotter play area, and expectations, I think, are higher than I think as the industry we're getting smarter again and we're pulling back. And you haven't seen a lot of deals in these plays for probably 3/4 of a year now, because I think the expectations from the seller are a little bit higher than what now the buyer's willing to do. So, I think it's a wait and see game on that front to see where we can kind of come to a pinnacle there of expectations.
I mean, you have the ambition to grow InPlay to $1 billion company. How are you going to get there?
Yeah, I mean, it's going to be both organic growth and acquisitions, and it's definitely going to be a combination of both. And I mean, our luxury of what we have compared to some companies, is we have a strong balance sheet. We have access to debt with our strong syndicate and potential other partners, and we're very confident we can raise a little bit of equity if required. So we're in a good spot.
So this ties into my past question: where do you envision InPlay in 3 years?
Well, I mean, so ultimately, I'm a multi-year oil bull cycle guy. We got to get through the noise that's in the world right now, and the recession noise. Belief that oil is going to be $75, $80 more consistently for the next so many years. You're going to see multiples expand to 4 times, maybe 5 times cash flow multiples, which has again happened consistently over the years. And I see InPlay being I would hope to be $1 billion plus company with sizable free funds flow, which ultimately, we can be returning that to the shareholders. And secondly, I think you'll see intermediates and seniors, I guess we potentially be an intermediate at that size, that they'd be looking at free funds flow as being, again, a way for them to increase their free funds flow yield and ultimately, pay their shareholders more. So, it all winds up into that sort of exit strategy of selling to somebody bigger that's looking for sizable free funds flow to pay back to the shareholders.